Imagine waking up one morning to find that every dollar you own exists only as numbers on a screen. Numbers that can be changed, frozen, or erased at the push of a button. Just a century ago, money jingled in your pocket or hid beneath your mattress. Today, it's become invisible, intangible, and in many ways, controllable in ways our grandparents never imagined. This is the story of how money itself became digital, and what that means for control, power, and your everyday life. For years, money was a physical thing. Whether it took the form of shells, coins, or paper bills, it was tangible, a token you could hold, exchange, or hide. In the early days of America, coins and banknotes changed hands with every transaction. If you wanted to buy a loaf of bread, you handed over a coin. If you were paid for a day's work, the boss would hand you cash. Money was real, and its ownership was hard to dispute. But as commerce grew more complex, so did our systems for managing money. Banks emerged as trusted institutions, storing valuables and facilitating exchanges. By the mid-20th century, bank accounts had replaced stashes of cash for many Americans. Statements arrived in the mail, and balances were tracked in ledgers. Yet even then, most transactions were still physical. People wrote checks or withdrew cash from tellers. The connection between a dollar in your account and a bill in your hand was clear and direct. This began to change quietly in the 1970s. The first major shift came with the widespread adoption of electronic payment systems. Credit cards and debit cards became commonplace, allowing people to buy things without ever touching cash. These cards were convenient, but they also introduced a new layer of abstraction. Now, money moved not as coins or notes, but as electronic signals between banks. Every swipe or tap initiated a digital record, a data point in a growing web of financial information. By the 1990s, the rise of the Internet accelerated this transformation. Online banking replaced paper statements. Paychecks arrived as direct deposits. Shopping happened with a click, and payment was deducted automatically. The digital dollar was born, and its presence grew rapidly. Today, less than 10% of all money in the United States exists as physical cash. The rest exists only in computers, data stored and managed by banks, payment processors, and governments. This evolution brought enormous benefits. Digital money is fast, efficient, and accessible. It allows for instant payments, global commerce, and unprecedented convenience. Businesses can operate across borders, and individuals can send money to family members thousands of miles away in seconds. Fraud is harder when transactions are tracked electronically. Governments can collect taxes more efficiently and provide social benefits directly to recipients' accounts. Yet, with these benefits come profound questions about control. When money exists only as data, whoever controls the data controls the money. This is a foundational shift with far-reaching consequences for privacy, freedom, and power. Consider the role of banks. In the old world of cash, your money was yours to spend as you liked. Today, banks act as gatekeepers. They can freeze accounts, reverse transactions, and monitor spending. Most Americans probably never notice this control. It exists in the background, a set of rules and regulations designed to prevent fraud and crime. But in practice, it means that access to your own money depends on a network of institutions and their policies. This control is not always theoretical. After the 2008 financial crisis, millions of Americans discovered that bank failures could make their money inaccessible overnight. In recent years, banks have closed accounts linked to suspicious activity, sometimes sweeping up innocent customers in wide-ranging anti-money laundering efforts. For people on the margins of society, new immigrants, gig workers, or those without steady jobs, this control can mean exclusion from the financial system altogether. Governments, too, have new powers in a digital world. Financial surveillance, once labor-intensive and limited, is now automated and expansive. Every electronic payment creates a record, and those records can be analyzed, shared, or subpoenaed. Law enforcement agencies use financial data to track criminal networks. Tax authorities use it to catch cheats. In an age of terrorism and cybercrime, these tools are often justified as necessary for security. But the same tools can be used for other purposes. In times of political unrest, governments have frozen the assets of protesters or dissidents. In other countries, authorities have blocked donations to opposition groups or used financial records to track down activists. While these cases may seem distant from daily life in the United States, the technical possibility exists wherever money is digital. The rise of tech companies in finance has added a new layer of complexity. Companies like PayPal, Apple, and Google process billions of dollars in payments every day. Their platforms combine financial data with vast troves of personal information, creating detailed profiles of their users. These companies set their own rules about who can use their services and how. In some high-profile cases, they've banned users for violating terms of service, cutting off access to funds with little warning or recourse. Digital money is also increasingly programmable. With the emergence of cryptocurrencies and blockchain technology, new forms of digital money offer the promise of decentralization, removing intermediaries and giving individuals more control. But these technologies also introduce new risks. Cryptocurrencies can be volatile, and their use can be restricted by governments or exchanges. The same programmability that allows for innovation also allows for restrictions, such as smart contracts that limit how or when money can be spent. Central banks are now exploring digital currencies of their own. The Federal Reserve has studied the idea of a digital dollar, a form of money issued directly by the government and held in accounts at the central bank. Proponents say this could make payments faster, cheaper, and more inclusive. Critics warn that it could give the government unprecedented visibility into every transaction, raising concerns about privacy and state power. All of these developments point to a central fact. Money is no longer just a medium of exchange. It has become a tool of control, sometimes for good, sometimes for ill. The ability to monitor, restrict, or redirect money flows gives unprecedented power to those who manage the digital infrastructure of finance. For most Americans, the shift to digital money is seamless and invisible. We tap cards, swipe phones, and pay bills online without a second thought. But beneath this convenience lies a deeper reality. Our financial lives are now shaped by code, algorithms, and institutional policies. Every transaction is a data point, subject to oversight, analysis, and, potentially, intervention. This reality raises important questions for the future. Who gets to decide what transactions are allowed? How much privacy should individuals expect when every purchase is recorded? What happens when access to money can be granted or denied by algorithms, banks, or governments? Some have responded by seeking alternatives. The use of cash in certain communities persists, a quiet form of resistance to digital oversight. Others turn to cryptocurrencies, hoping for more autonomy, though the promise of decentralization is not always realized in practice. Privacy advocates push for stronger protections and clearer rules about how financial data can be used. The debate over digital dollars is not just technical, it's deeply political. It touches on fundamental questions of liberty, fairness, and trust. As money becomes ever more digital, the lines between convenience and control, safety and surveillance blur. Looking ahead, the trajectory seems clear. The United States is moving toward an ever more digital financial system. Cash is fading. Digital wallets, instant payments, and online banking are the new normal. Central bank digital currencies may be next. Each step brings new possibilities and new risks. Ultimately, the story of digital money is about more than technology. It's about who holds power in society and how that power is exercised. The shift from